What's up, people? Welcome back to Invest with T-Claus. My name is Tevi, and this channel is dedicated to my investment journey, along with coverage on crypto, Tesla, NEO, Virgin Galactic, and ChargePoint. Come for the information and stay for the perspective. So earlier this week, Tesla held its Q1 2023 earning call, and if you were to go by the nearly 11% drop in the stock price, one could think that this was a terrible quarter. But before we dive into the Tesla results, it is worth noting that we have a big earnings week ahead of us. The focus will be on mega cap tech, with Microsoft and Google parent company Alphabet reporting on Tuesday, followed by Meta on Wednesday and Amazon on Thursday. Also worth paying attention to is Visa and MasterCard. The relevance here is that there's been a ton, and I mean a ton of talk about how the high interest rate environment is pressuring businesses and squeezing margins, right? If margins are compressed and or revenue slows down, then valuations would need to be adjusted lower, which ultimately means that market would need to revert lower as well, at least in the near term. Overall, it's been a decent earnings season so far, but a miss or a beat by mega cap tech has the potential to shift momentum in either direction, hence why paying attention here matters at the macro level. Now, with that said, the main question for today is, why did the Tesla stock drop post-earnings? So in today's video, I'll go over the main takeaways from the earning call. We'll check on the overall sentiment around the stock from analysts and close with what I'm personally doing. As always, this is not to be taken as financial advice. I am not a financial advisor. This is my personal approach to investing and the thought process behind it. I'd recommend watching all the way through so that you don't miss out on any pertinent information I'll be sharing. Drop this video an early like if you haven't already, and hit that subscribe button. Those are two easy ways to show your support to the channel and help it grow if you appreciate the content. All right, let's get into it. All right, so let's start with the good. In Q1, Tesla produced 440,808 vehicles and delivered 422,875 vehicles. That's a new record and absolutely impressive, to say the least, when you consider that Q1 is relatively short due to holidays like the Chinese New Year. Earnings per share came in at 85 cents, which was in line with expectations. Revenue grew 24% year over year to $23.3 billion. This represents a beat on analyst expectations against a projection of $23.21 billion. Now, their cash position increased sequentially by $217 million, reaching a total of $22.4 billion in their cash war chest. This was fueled in no small part by free cash flow at $441 million. Installed capacity, meaning what they can produce, has increased from 1.9 million cars a quarter ago to now 2 million cars this quarter. And that's in big thanks to the improvements at Giga Berlin. Something that doesn't get a ton of airtime but is important to note nonetheless is the energy side of the business, okay? Energy storage deployment increased by 360% year over year. That's massive. Solar deployment increased by 40% year over year. Last but certainly not least, on a new product front, Elon highlighted during the call the progress on Cybertruck. They've gone through and completed winter testing. The pilot line is up and assembly of alpha models is ongoing, with expected deliveries to customers still on track for Q3 this year, which makes me super happy. Anyways, this is something that Elon touched on right when the Model Y was launched and nobody believed him, but the Model Y is now not only the best selling vehicles in Europe bar none, but it also takes the crown in the US market, excluding pickup trucks. So again, you really don't want to bet against Tesla or Elon at this point. Now, for the bad and the reason why the stock is down, the short answer is profit margins, okay? They're down to 19.3%, while previously Elon and team had stated that they didn't expect them to dip below 20%. Elon and team basically explained that they intend to focus on growing production while continuing to utilize price reductions where appropriate to gain market share, even if that means lower margins in the near term. The main reason being that they fully expect margin to increase over time as they scale up, gain further efficiency through the manufacturing process, and capitalize on software offerings via the rollout of full autonomy. I would say personally that this does seem like the right play for long-term sustainability and growing the business, but you gotta understand that Wall Street is very nearsighted and mostly cares about the here and now. And by that measure, it's important to be aware that the stock could see more volatility, as we likely have at least a couple more quarters of pain due to margin being compressed a bit lower. It is important to note and realize that despite the lower margins, Tesla's margins are still at least double of that of traditional OEMs who all operate in single-digit numbers, okay? Now, another important point to take note of is that Tesla is the only EV maker who has the pricing power and big enough margins to even pursue this strategy to begin with without meaningfully impacting the business in a negative way. That is a major flex on the competition and why Tesla is in a league of its own. But make no mistake, those bearish on the stock will cling to the narrative that lower margin can create, and these type of headlines here will absolutely incite more fear, uncertainty, and doubt. That said, it's important to look at the full picture. Despite the price drop, there is no change in the overall consensus rating, which is still a moderate buy. We're sitting at 32 ratings total over the past 3 months, and the breakdown is as follows. We have 17 buys, 11 holds, and 4 sell ratings. The top end of the range remains unchanged at $300. The median price target is a bit lower than the last time we covered Tesla, and we're now at $208.56. But the lower bound of the price range has come up to $115, which was previously at $89. Now, during the last stock price rally, the record delivery numbers for Q1 turned out to not be enough of a catalyst to push us up to or past the 200-day moving average. And with this most recent move lower, not only did we break below the 50-day moving average, but we're now also fast approaching entering the oversold zone, meaning that technically we could go a bit lower before rebounding. Again, I would pay attention to the mega cap earnings next week, as those will more than likely dictate momentum at the macro level, which could either exacerbate a move lower for Tesla or bring about stabilization. And so, given that I was a bit too optimistic prior, I'm adopting a wait and see approach here. As I've said before in my last video, I'm not in any big rush to add to my Tesla position as I've reached my target goal, but we are certainly at attractive levels where it may soon make sense for me to DCA some more. That said, my eyes are focused on Allright, who thanks to the Bitcoin pullback has corrected nicely after going into the overbought territory. Near term, that's where my capital is likely to get allocated. And so the last thing I will say is this. Tesla has time and time again proven that they are leaps and bounds ahead of the competition. If you pay attention, you'll realize that the vast majority is no longer questioning the innovative DNA Tesla has or the industry-leading manufacturing capability they possess. The focus is no longer on can they be profitable, but rather how much more profitable can they be to justify the high multiple built into the stock price. Wall Street is laser focused on the near-term quarter-to-quarter growth, while Tesla continues to communicate their long-term strategy and are unapologetic about sacrificing some near-term profit for long-term growth. That misalignment is what creates opportunities for those of us who see the vision and can afford to sit back and let it play out. No matter how you slice it, the Tesla stock will be significantly more valuable in 2030 than it is now. So it's up to each one of us to invest based on conviction and our time horizon. But on that note, that is it for me today. If you found value in my content, click that like button and share with others who you think could also benefit from it. For my newcomers, subscribe, it's free. And don't forget to ring the notification bell so that you too can stay in the know. I'll be back on Sunday for my weekly video. Till then, you can keep up with me here on Twitter for crypto and NFT related news. Thank you for watching, stay humble, hustle hard, and I'll see you in the next one.